this is one of my favorite things to talk about in all of macro, because it would seem to me that just about every macro tourist is on the wrong side of this bet. And I don't mean the wrong side in the sense that the Chinese yuan is not going to go down. It's going to continue to go down in so much as the dollar is going to continue rising. There are capital outflow pressures from China. The issue with expecting a material devaluation, say on the order of 35% or even something less than that, is the fact that China has a closed capital account, and you just don't have the same sort of sudden stop risk in China as you do in other emerging market economies where you have seen material devaluations on this magnitude.
Because you have, explain that to people who don't know what a closed capital account means relative to an open capital account or liquidity or foreign fund flows.
So, yes, so money
so
is
who doesn't have a closed capital account?
Brazil. So a country like Brazil or a country like Indonesia, where money is flowing in and out very loosely, can obviously experience a great deal of capital inflows during the boom times, during the times where the real or the rupee are rising, and then obviously on the flip side of that, you can experience a great deal of capital outflows from foreign investors to the extent that those economies are slowing or those currencies are falling. China has a closed capital account in that it limits and restricts the amount of two-way investment flows in and out of the country, which tend to be the predominant driver of currency fluctuations. So to put some numbers around that, China's short-term external debt as a percentage of total foreign direct investment, which is a proxy for how much money they need to pay back and use foreign money to pay back, is only 10%. That's about half of what most emerging markets have. It's about 19% for the sample of emerging markets that we track, which is about 25 countries. Inbound portfolio investment, which is the biggest culprit of short-term large currency fluctuations. China's only at a lowly 3% relative to 16% for most other emerging, or for the average for the rest of the emerging markets in our sample. So again, China has a very closed capital count, very low portfolio inflows. Those tend to be the kind of hot money inflows that are much more flighty than foreign direct investment inflows. And then lastly, dollar debt as a percentage in foreign exchange reserves, which is the key issue for a lot of these emerging market economies.
Because they borrow in dollars.
They borrow in dollars. Not only do they borrow in dollars, but they also increasingly dollar-based investors have been allocating assets to their local currency sovereign bond markets. So on the order of about 25%. So foreigners own about a quarter of EM sovereign debt markets on average.
Because a lot of foreign investors have sought the yield.
They're seeking yield. It's a yield chase. It's a gigantic global yield chase.
Whereas China doesn't do that.
Of course, China does not do that. So China, that dollar debt as a percentage of foreign exchange reserves is only about 35%. That's about 100% for the average for most other emerging market economies. So I think what people are expecting is sort of some sort of EM style currency crash, currency debasement, devaluation that we've seen in historic episodes, and not really doing the work on, okay, does China have these types of risks? Is this going to happen to China? What's the probability that this happens to China? Well, the math would suggest that it's unlikely to happen, certainly not to the same magnitude, and also the policy. So don't forget, these guys prefer economic and financial market stability. They're not of the mind to pursue a large material on-off devaluation. So not only do you have the math on your side, you have the policymakers on your side as well. So what's likely to happen is they'll continue to support the yuan on the margins with foreign exchange reserves and administrative controls in and around the capital account to prevent a much more steep depreciation of the yuan. So again, be bearish on the yuan. The yuan's going down, but I think anyone wasting options premium on some sort of big one-off move is likely to sort of...
Well, it's an interesting asset management product because you can scare the hell out of people by establishing, people that don't know, that A, China has a closed capital account, but B, don't know the difference between traditional emerging market risks, currency risks, and China. Yeah. So, which is one and the same thing due to the closed capital account. So if you're out there and you want to start a $1 billion short only, just begin buying options on that event, 35% downside, you know who the winner on that trade is?
The guy selling you the options.
Exactly. Whoever's getting, who's getting the asset management fee on that. It doesn't have to happen. It's just sitting there saying at some point we're going to have a volcano. But guess what? Use a better metaphor. And I wrote it down here. So I challenge you to go to the world's best investors who've been calling for a 20 to 50% decline in the Chinese currency to explain to you why this isn't true. If they tell you that that's not true, they're telling you fake news, okay? So write that down. You learned something today. China has a closed capital account. Think of it like China has You live in a part of the world where there's an extreme amount of flooding risk to your basement. China doesn't have a basement.
Yeah, that's a pretty good way to describe
They have a
it.
core floor, okay?
Yeah.
Now, you know as well as I know, if you built a house, that if you have a core floor structure, you can't flood your basement because you don't have a basement.
Yeah, it's pretty good.
Okay? Now, we can't say that there can be mold on your core floor, that you can't have like a lot of different issues surrounding your home, but the notion that China's closed capital account is the same as living in Louisiana with like a 12-foot basement is absurd. It really is absurd. So, boil these things down to what are the mechanisms that could have a flood. A 35% flood in the Chinese currency, we'd again submit that you'd have to have a basement that can be flooded.
Yeah, no, and this is the problem. I mean, there's two issues with this. There's so many other obvious currencies to short. Like, go short the Mexican peso, go short the Turkish lira, go short the Brazilian real, go short the Indonesian rupiah, go short the euro, go short the yen. Why are people so hell-bent and so focused on shorting the yuan? It makes no sense.
Because it should be.